This is what you've got to say, Marko. We do not recommend trying to catch a falling knife. Bonds are not selling off today because of America's poor fiscal profile. The US is not in a debt trap, but they may be in the future. So very good morning to you. Explain to me then why we've had such a violent shakedown in this bond market at the moment. Good morning.
Good morning to you too, Manus, and thank you very much for having me on the show. I mean, I think that this move in bonds is at this moment purely because of the optimism in the US economy that was severely underestimated by all the Fed watchers that thought that somehow the 12th Olympian gods on FOMC could somehow slow down the economy with Fed rate hikes. Of course, what was severely underestimated is the strength of the US consumer. And what continues to be completely misunderstood by almost everyone in the markets is that there is no excess savings. That is a completely vacuous argument. US households have far more cash on their almost perfectly clean balance sheets than anyone really thought. And so that is really powering the economy. And as it does so, bond yields had to reset to this collapse of the recession narrative that's occurred over the last couple of months. The problem, of course, with my view, is that if that's true, then that means that higher inflation expectations or some sort of a debt crisis in the US is yet to be priced if it does get priced in, which means the move on the yields could go higher from here.
Okay, you say that you're in the mild inflationistic camp. 3 to 5% is where we're going to settle. Has that reality hit home, Marko? But more importantly, if that is your reality, then what is the reality of where bond yields actually get to?
You know, so when you think about a 10-year fair value yield, there's really three components to it. One is term premium, which has risen because QE has ended. Then you have the R star, which is what we were talking about until now, just a healthier US consumer than anyone really thought. The neutral rate is therefore higher. The long-term inflation expectations hasn't budged at all, Manus. So I'm in this mildly inflationary camp of, let's say, 3% for the rest of the decade. I mean, the five-year forward is basically telling you we're at 2.4%. It's nailed to the ground. So that's your long-term inflation expectations. A little bit forward are not much higher or lower. And that's what's really fascinating to me after all this extraordinary fiscal stimulus that we've had, after basically the Fed being way behind the curve in 2021, in my view, still being behind the curve. There's been no rise in long-term inflation expectations. And so when you put all those components down together, I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No, there's so many investors.
Why not, Marko? Why can't I buy bonds right now? We're almost at 5%.
Right. So because so many investors are holding hundreds of billions of bonds with the idea that the fair value is at 3 or 3.5. And if it's at actually 5, then it's likely the yields will overshoot as many investors sell their portfolio of basically overvalued assets.
Marko, with that landscape that you've just laid out in front of us, you also put forward the thesis that an outright move to yield curve control in the United States of America in the long term, I mean, you're not saying it's next week, you're not saying it's at the beginning of next year. We're going to get our comeuppance as a result of this largesse, the unnecessary fiscal stimulus. But what could invoke YCC? Because it's quite a radical thing to say that the US bond market would need YCC. How and why would that come to pass?
I think that would be some sort of an uncontrolled move in bond yields towards what, you had Jeremy Dimon talk about, like 7% in the 10-year yield. I think that, let's take it one step at a time. There is a self-correcting mechanism where once bond yields go over 5%, given where oil prices are, given where the 10-year yield would be at that point, you're starting to have a lot of headwinds to the economy. And if recession risk rises, at that point, I think yields would come down. Folks would start moving towards the safety. So yeah, I mean, that would be your self-limiting mechanism where I don't think we would need yield curve control. But if we get an uncontrolled move in bond yields, as you saw with the United Kingdom earlier in the year, what did Bank of England do? Or for example, after SVB, what did we do in the US? We instituted the Bank Term Funding Program, which is essentially an American style of European LTROs, where you use the
Marko,
private sector.
To that point, we're at this moment, and again, to that point of the private sector, we're at this moment where debt is moving out of bank balance sheets and increasingly into non-banking financial institutions. And we have a Fed whose policy is transmitted through banks. Are we about to face a crisis of bond markets that can run away without that helping hand of the Fed?
Well, yeah, I mean, if there is no helping hand of the Fed, of course we could. Absolutely. As I said, if the fair value is 1.5%, 2% higher on the 10-year yield than most investors have thought, then many are holding overvalued assets on their balance sheet, and they will start dumping them. And in that situation, of course, you have this uncontrolled move, the Fed will step in. And so I think that right now, investors are in a very, very dangerous moment. We're traveling with events, and I think the only real view you can have is on the 10-year yield, and then you have to watch how policymakers react to it. And if the
Some blistering warnings from there, and I'm going to quote you again. I mean, I got to say, I love this note. First of all, you put yourself up as being a heretic. It's brilliant. But yourself and the team there say, I mean, I wish I could be so honest at 5 a.m. on the show. The Fed is merely traveling with events. It's a price taker in CapEx in this cycle, defined by structurally higher aggregate demand. I mean, what did the Fed try to do in the past 24 hours? Because the rates market is fighting against the Fed. So has the Fed got to do more to regain control here, to regain the narrative?
I'm not sure that that's what they need to do. I mean, the 10-year yield is in many ways doing what they couldn't do, which is slow down the economy. And that's the point. That's the argument for buying bonds right now. Well, okay, this is unsustainable. Well, we'll see. We'll see which level is unsustainable. Market moves and paradigm shifts, when they get priced in, they tend to overshoot. That's why I'm not a buyer at this moment. But the point is that as the 10-year yield goes higher, that does increase borrowing costs for the economy, and that will slow down the pace of growth, even with my quite bullish view of the U.S. consumer. And so I don't think the Fed has to regain the control of this. I mean, it really depends what they're trying to accomplish. My issue is that I'm not really sure what they're trying to accomplish. I'm not sure that they know either. And that's why I think
Marko, you write in your note that it's clear that the Fed is pivoting for largely political reasons. I mean, that's quite the statement. Is it that clear? Why is it clear to you that it's political reasons behind their actions?
I think the reason for that is that, inflation has fallen down almost purely for supply reasons. It is very difficult to see any sort of impact on demand by the increase in the Fed funds rate. U.S. consumers have just blown through 5.5% in terms of Fed funds rate increases. Continue to consume. Auto sales are up as rates are up. A lot of that has to do with very strong real wage growth. And so what I'm saying is that if the Fed really wanted to get us to 2%, they would have done that by increasing rates more. Instead, they're pivoting away from that. They're pausing right as we get confirmation that the economy is actually quite robust. And so I think the fact that we're 12 months ahead of the U.S. election, they don't want to be political. They don't want to be perceived as political, which they would be if they induced a recession for the sake of 2% CPI. I think that is definitely playing a role in them pausing. But they're pausing as they pause, and as investors realize that growth is much healthier than it is, that there's really no reason to hold bonds at 3.5%, 3.75%, 4%. You want to dump them, you want to sell them off, and that's creating this bond yield increase. If they didn't respond to that with some sort of a way to talk down the yields, that will be an uber dovish move that will definitely reveal that they have, sensitivity to a very epic election coming up.
Okay, it's certainly going to be epic, and I'm delighted to be on the shores of the U.S. to watch it. Marko, let's give it a second go. I'll maybe get the name right this time, Marko Papic. Clocktower Group, with his calls on bonds, politics, and an epic election to come.